Welcome to StockOdds and we're here getting ready for the week ahead. Good evening, Rob.
Good evening. Saturday here, we're hitting it. And yeah, there's been a change in NVIDIA, hasn't there?
If you own that, you're pretty much set. You don't need all the stats and high-tech stuff we do here.
Exactly. So let's get to the Friday, March the 8th. So what we had is we had the non-farm payrolls release, and that really launched the market. We had a move up to at 10 a.m., kind of that peak. That's often a pivotal time. And from there, we had lower highs, high signal, and really had quite a sell-off. On the note of NVIDIA, for example, it was up over 5% at this point, and by the end of the day, it was down 5.55%, so quite a move. So we'd had some good signal during the day, and finished off a little bit above the low of the day, but quite a reversal day. Now this is the 15-minute chart for the week. We opened here on Monday after a really nice smooth rally on the Friday. And it was kind of a wait and see game, and all of a sudden, I don't know if people got cold feet ahead of Fed Chairman Powell's testimony, but we ended up selling off on the Tuesday. Wednesday and Thursday were his testimony, and that did perk the market up quite substantially. We also had CrowdStrike earnings that came through, and that was a big boost. That's why you see this market gap here. And then February non-farm payrolls, as we mentioned, launched the market, and it reversed on that. So we finished the week, just slightly lower than where we opened. And for the week from the previous close of the week was slightly down. This is the SPY daily. You can see that reversal on the chart. Things have still been moving higher, and we'll have to see if it will recover from that. This is the Qs here, where we had a little bit more aggressive a sell-off just because of the tech, space and what was going on in terms of profit taking. Here's the diamonds here. We had they've been lackluster. Didn't really participate in that big spike up. And again, this is a price-weighted index, and it's more defensive, so you don't get that FOMO, the fear of missing out, and all the chasing stocks. Here's IWM. It did participate a little bit in the rally, but it had a very significant reversal. It doesn't like it when the Nasdaq 100 stocks, especially the mega caps, fall out of bed in any given day. Sometimes the next day it can do better than the Nasdaq, but when you have a reversal day, the IWM, the Russell 2000, doesn't fare very well. So here's the sector performances for Friday and the week. We see real estate came out on top for Friday, and that was because the Treasury yields sold off. The Treasury bonds were rallied again, and the yields sold off, and that really benefits real estate. And you can see technology had a bad day. Down for the week, it was the consumer cyclical, Amazon, Tesla, that were mostly under pressure. We had utilities. It really came around. Do you find that surprising? We see this every once in a while. So probably out of the 52 weeks of the year, we see utilities on top maybe 3 times, 3 out of 52, but definitely utilities took it. And basic materials fared okay, and that was because of the collapse of the US dollar. And then real estate as well, because of the benefit of the yields moving down. So that's where we find our weekly performance there. For the sector, now we had average volumes were okay for the week and even on Friday here. We had XLC communications with Meta and Google that had higher than normal volume for the week and for the day. Over here in performance for the week, we see Qs down as little bit less than the XLK and XLY. So you've got your risk on components here getting punished for the week, where utilities were on top. So it wasn't that our risk on list, had a bad day every day. I mean, there was some days that it was pretty poor performing, but for the week overall, even though we had that rally, the game went more to the defensive side, and of course, basic materials and real estate in there too. Here's the map of the market for Friday. You can see how bad the semiconductors did. Really, the leadership was the Broadcom and NVIDIA. Broadcom because of earnings, there was a disappointment there. And NVIDIA just had that reversal. I think the hype on AI got so loud, so pronounced that might be it. But this is definitely the tip of the spear, and it does impact everybody else as well. Over here in the consumer defensive, the reason it didn't do better was because of Costco. Costco missed on the revenues side of it. I mean, headline earnings was not bad, but in the fine details, we see Costco missed some things. Now, contrast that to its previous earnings release, where it really knocked it out of the park. So Costco, definitely some profit taking. It's been a strong stock. Lilly profit taking on the obesity drugs, weight loss pill, things like that. It's been strong for the last year. So every once in a while, have some profit taking. Real estate doing good. Energy came about as it often does on a Friday. Usually you get a little bit of a rally for energy because of the weekend concerns. Now, I want to point out Apple here because often when you see weakness in some of these other stocks that have the leadership, that's when you see strength in Apple. And the reverse is true. Apple really drags or lags when they're really strong. So kind of the opposite things going on here. Google's had a pretty poor performance for a while, but it bounced back a little bit. Tesla's all over the map, one day to another at times. Here's for the week now. Now you can see that even though Apple had a bounce back on Friday, look at what it did for the week. And that's more what I'm talking about here. NVIDIA was up 6.38% for the week, even after its pullback on Friday. Apple was up on Friday, but down for the week. Very important to monitor relationships like this. You see that sort of competitive thing all through the landscape of the S&P 500. Like Airbnb, Booking, McDonald's versus Starbucks. Often Walmart and Target at different odds, and often Lilly versus Merck or Lilly versus Johnson & Johnson. So it's all through this, and you have to monitor those relationships because it can really help you on any given day to see when they drift apart. All right. Now here's a daily chart of NVIDIA. I want to show that over 10% pullback from the high. And you see how steep the run's been. So is this the end of the move? This is a high volume profit taking move. Or past earnings, we got to wait till maybe another cycle. It's only had out of the last, 1, 2, 3, 4 earnings, it's only had one that it pulled back on right away. This one here. Everything else it kind of launched higher after earnings, same as here. So we'll have to wait, but I want to show you this chart, which is the weekly chart of NVIDIA. And that kind of puts things into perspective. If this is the tip of the spear, this is the spear right here. We almost tagged 1,000 on it. Now I know there were some analyst calls for higher than 1,000, but I don't think when it was trading down here in this sideways channel that people thought it could actually get there. But a reminder that sometimes the length of channels equate to the rise afterwards. So if you look at the distance that this thing went sideways and it finally broke out, it pretty much moved that same distance, but vertically. So this is a very curious thing. I think what's going to happen here is whatever this high is going to definitely be something to lean on, and it's going to have to, after a pullback like that, it's going to have to fight to regain that that price level. And if it goes through it, then of course you got the 1,000 to test. That'll be critical. That's like a stock going from 90 to 100. That 100 becomes, a big deal.
What if they do like a stock split or something too? That's another.
Yeah,
catalyst.
I mean that's true.
When a lot of stocks
Like
get
everything
devalued.
else.
Yeah.
Yeah, we've seen that movie. I mean, and the thing is, if they say they are going to split, sometimes it runs a little bit more before the split day too. So here's a daily chart of old-fashioned gold. So look at that move. That's a pretty staggering when you consider that the market was going up for the most part too, and the things that the Fed was talking about were really pretty confirming that we're going to get some cuts this year. So I'm going to give you a reason for this here shortly, so keep with me. Here's the daily chart of the new sexy gold, which is BTC. BTC is moving towards its halving event, and there's a big sentiment in play again, which obviously wasn't present during these months, but it finally broke out. And again, look at the length of the channel, and we're starting to see upward movement, getting away from all that. And
it looks just like NVIDIA's chart though, right?
I know it's true, right? Well, I mean, not that NVIDIA cards are used for Bitcoin mining, they're used for GPU mining, but there's always been that kind of relationship, right, with crypto and NVIDIA, and even, NVIDIA cards being used for AI, right?
More just appetite for risk. This is just showing how much risk people are willing to take right now.
And they are, and you know why? Fear of missing out is so huge, right? And it can be a real driver, which is what causes sometimes these, spikes, and then when it falls and it finally gets back to where it was again, if it cycles back up, you see that it hits resistance. That resistance is created because people are thankful that they got their money back, and they end up selling and getting out of it just when it gets back to where they bought it. So that happens over and over again. So here's some currencies. So here's that slide of the US dollar I was pointing out here. And you can see that in the cable, it's British pound, it's moving up. We had euros moving up. Now, Japanese yen is also moving up here. This is important. I'll point out in a little bit why. Australia, so commodity-based countries, New Zealand, Australia, Canada, tend to benefit from a pullback in the dollar because they're commodity-based currencies. So when the dollar pulls back, commodities rise, as we saw with gold. And gold actually rallied more percentage-wise than this pullback of the dollar. So something else is going on with gold as well. And it's funny that, old-fashioned gold and Bitcoin gold are rallying at the same time. Okay, here's the daily chart of the 10-year note. You can see the rise that we had here. Again, that certainly doesn't equate to what we saw here, but this was the anticipation of interest rate cuts coming this year, and they were proposed originally for March, and then April and May became the one month that everyone hung their hat on. I've been talking about it being in July, possibly the earliest. But here we see this spike again. So what is going on? Okay, we've looked at the dollar pulling back, commodity-based countries, currencies rallying, Japanese yen rallying. We see gold rallying, Bitcoin rallying. What's going on? Treasuries rallying again, even though it seems that the interest rate cuts aren't going to be till maybe later in the year. Well, we had a little rise in the VIX here on Friday. It got some people excited. I know traders watch this closely and can be very important for whether they should take risk off the table or put more risk on or catch a turn, whatever. So we were discounted when the market was rallying after the non-farm payrolls, but it started to turn around and we sold off fast. So the VIX really rallied. And why this rallies is because portfolio managers are taking and buying puts to protect the money that they manage. And then late in the day, it kind of tapered off. Okay, why don't you take it away with the economic reports here?
Yeah, this week we don't have much Fed speak or Powell, but there's two themes: inflation, basically. So Tuesday we have the core CPI, which is a number that's going to be watched a lot, 8:30 a.m. Eastern, and then on Thursday we have the PPI, the producer. So these are going to show how tame inflation is, and this will give markets hope for rate cuts or information as to holding higher for longer. So that's going to be the biggest theme for the week there. And then there's some retail sales on Thursday, and consumer sentiment might be a good one on Friday. But it's not one of those weeks where it's all Fed. It's going to be really just about inflation and then guessing what the Fed's going to do on that.
Definitely about inflation and also the narrative of, is this soft landing that, all of the economic reports last week and even Powell's testimony seem to indicate. And so there's a lot riding on this soft landing versus a recession. And I think the CPI and the core PPI are very big elements of that. And we've got Empire State for March. So this is kind of current, see what's going on with that, import prices, things like that. All of it can matter, but as Dave said, the PPI and CPI are the bigger items. And then here's your earnings calendar. So that's kind of really hard to. Oh, whoops, we got the wrong one that came up. Got the wrong one here. Dave, you got any earnings that you got on your radar, right? You can pull up? You there? Did I lose you?
Oh, sorry, I had mute on. Yeah, on Monday we have Oracle. That's a big one. And then on Wednesday, Dollar Tree. So that, again, that ties with the retail spending, how the consumer's holding up. Thursday, Adobe. So another tech stock and software. So the big ones are Oracle and Adobe. And then Dollar Tree is going to show us how the lower consumer is doing.
Okay. We're still a bit away from the major earnings. They'll just be very spotty going forward. And then we start into the beginning of April with the heavier earnings season again. Let's go to, let's see here. This is an earnings calendar, but I'll just put up, and this is related to just some talking points. So we've got the New York Community Bank. They've got a $1 billion lifeline. We've got regionals back in focus again. And we got this note that banks will likely have to pay billions more still. The FDIC this week revised its total loss figure from March 2023 failures up by roughly $4 billion to $20.4 billion. So it's a sizable increase there that banks are going to have to pay. Dave, you notice a few days we had some real banking weakness. Some of it was related, I think, to interest rates, but some of it was related to probably this news coming out.
Mm-hmm. It's almost been 1 year
You
since
definitely have to watch the regionals.
Yeah, it's been almost a year since Silicon Valley, and this is still an issue out there.
Well, remember we were talking about kind of in some areas this will be a redo year, like this thing cycle back again, and same movie, different year. It's possible that this could, start again for regionals this month of March, like it did last time. So, I think they want to fight it with everything they got, but at the same time, we don't really know what's in the works. Interest rates did go up very quickly. We know that the positioning of those regionals was not good. We've got commercial real estate exposure, and we still have had elevated rates. They haven't been cut yet, so I don't think the pressure has been relieved. And a lot of things are coming due. So we're seeing that in the consumer space, and we're seeing that here in the regional banks especially. The money-centered banks probably are okay. Like the too big to fail really does matter. But regionals, they're another story. Then we have speculation surge that the Bank of Japan will move this month to raise interest rates for the first time since 2007. Imagine that. That's crazy. After a flurry of reports and wage figures helped drive up the yen bond yields and overnight swaps. So bets on the March 18th to 19th meeting, which is coming up soon, are gaining traction as reports emerge that some Bank of Japan officials favor an early move, while some government officials also support a rate hike. Economists and investors are largely in agreement that the Japanese central bank will scrap the world's last remaining negative rate either this month or in April. What does that mean? Well, this could impact the yen carry trade, which underpins US dollar strength and the US stock market. So we showed you that the US dollar is selling off. We showed you gold rising. We showed you that the VIX has been quite low, could potentially become elevated again. We've seen reversals that are, kind of strange when you have a stock that's been so strong like NVIDIA, and it goes from up 5% in the morning to down 5.55% by the afternoon. We see Bitcoin strength, and I think you have to separate that risk on versus risk off thought with Bitcoin from what used to be. I don't think it's there to the same extent anymore. And the reason is institutional adoption, spot ETFs, more adoption in general going on, I think. And then also people viewing it as, if the debt situation really becomes serious and, people want another alternative, defensive place to put money or whatever. So I think it's just the narrative's changed on that from what used to be more of a rally in Bitcoin when it was risk on to more of a defensive posturing. Does that make sense, Dave?
Yeah. Yep.
So just this is a big concern here because the U.S. stock market is underpinned by the yen carry trade. Okay, that means that yen was borrowed at zero interest rates and less, right? Negative interest rates, and put to work in U.S. dollars and the U.S. stock market for higher yields. So if the yen starts rising, that can bring the money back and basically start draining it out of the market, which is really what you would do. You take profit, right? If you feel that the risk has changed, if you feel that profit taking is necessary, then that's what you do. Okay, makes sense?
Yep, and an options expiration on the 15th. So
we have you can go look at our seasonality calendar for the expiration event itself and what seasonality we have there. So check out the ETFs as well as the individual stocks. Okay.
Right.
We've we've showed our seasonality calendar quite a few times in our show, so I think people are familiar. Go check it out for yourself. It's easy to use, and just go to March 2023 because you have to go back a year, right? We haven't got to expiration yet in 2024, so we're looking back at 2023 and the previous 8 years, and that will tell you what the probability is for your ETFs and for your individual stocks. Okay.
All right. Good luck.
Thank you, Dave. Take care.